Ever wish you could, I don't know, just kind of set your trades and let them run, especially when the market seems to be on a roll?
Well, who hasn't?
Exactly. We're diving into a strategy today that might just let you do that credit spreads,
Mm-hmm.
and we'll be zeroing in on how they could potentially help you profit from the S&P 500's tendency to, you know, generally climb higher.
Right. And these are especially powerful when you throw in a bit of automation. We'll be talking about at-the-money credit spreads specifically.
Awesome. So for those just starting to explore options trading, can you break down what a credit spread is? What are we really talking about here?
Sure, think of it like this. You're buying and selling put options, but they have the same expiration date. The catch, they're at different price points, which we call strike prices.
Okay, so we're playing with puts. Got it. But what are we actually trying to achieve with this?
The goal is to get a net credit when you enter the trade, hence the name credit spread. Now, for a bullish spread, and that's what we'll be focusing on today, you would sell a put option with a strike price pretty close to the current market price, and then buy another put at a lower strike price.
Okay, so we are aiming to profit from the difference between those premiums.
You got it. And one of the coolest things about this strategy is you know your maximum loss right off the bat. It's simply the difference between those strike prices minus the credit you snagged when you entered the trade.
So it's like you're setting the boundaries of your bet before you even place it. Makes it a bit less scary, I guess.
Exactly. And it brings us to the important point of risk management. One way to manage risk is by only risking a small percentage of your total account on any single trade. We often recommend a strategy where you risk, let's say, 2.5% to potentially gain 2.5%.
I like that. Limiting those losses while still aiming for a solid gain. That brings me to my next question. What makes credit spreads stand out from other option strategies? Why should our listeners be particularly interested in these?
There are a few key advantages. One that really stands out is something called time decay. Basically, options lose value as they get closer to their expiration date. And with credit spreads, this actually works to our advantage.
Wait, time decay working for us. Isn't that usually a bad thing?
Not in this case. Think about it. If the S&P 500 stays above that strike price of the put you sold, you get to keep that sweet premium you received up front, even if the option itself expires worthless.
Okay, I'm starting to see the appeal here. So as long as the index doesn't take a nosedive below that level, we're golden.
Pretty much. And another good thing about credit spreads is that they require less margin compared to some other option strategies, like just buying options directly. So they're a bit more, capital efficient, especially for newer traders.
That's a huge plus for sure. Now let's circle back to that S&P 500 trend we mentioned earlier. You said it historically tends to move upwards. So how does that factor into credit spreads? Why is that important here?
Well, that's what makes bullish credit spreads statistically more likely to be winners. In fact, win rates can even go above 50%, especially if we're strategic about our timing.
So we're not just relying on chance here, we're playing the odds, but in a smart way. Okay, so then how do we know when it's the right time to jump into these trades? Do we just go for it whenever?
Not exactly. We analyze the market looking for times when the S&P 500 is making a steady climb or when we think it's about to bounce back from a support level. It's all about identifying those prime moments to make your move.
I see. So it's not just random. It's about being able to read the signals, know when to make your move. All right, and what about those strike prices? How do we decide which ones to actually choose? There's got to be some balancing act between risk and reward, right?
For sure there is. If you want a 1.1 risk-reward ratio, you'd sell a put option with a strike price that's close to the current market price. Then the put option you buy acts as a sort of safety net with a lower strike price, helping you limit your potential losses.
So the bought put is like our insurance policy, just in case things don't go according to plan.
Exactly. Now, if the S&P 500 stays above that upper strike price you chose, you can actually just let those options expire worthless, and you walk away with that whole premium you got up front.
All right, now that sounds like a win. But what about, repeating this process? You mentioned that earlier. Why is that a key part of this strategy?
Well, here's where the magic of compounding really comes in. See, with credit spreads on the S&P 500, options expire every single day. So you could theoretically set up new spreads every day, and tweak those strategies as you go.
So multiple trades each week, all with the potential to make some profit. I can see how that adds up over time.
Exactly. And the more you trade, the more you'll get a feel for those market signals and, get comfortable making those strategic decisions.
This sounds like a pretty solid way to potentially build a regular income stream from trading,
Yeah.
But what about people who maybe aren't super comfortable managing trades all by themselves. There are other options out there.
That's where automation can really shine. There are services available that can basically automate this whole process for you, taking out a lot of the guesswork.
That's really interesting. Tell me more about those automation options. What are we talking about here?
So there are a couple of exciting routes you can go. First, there's global auto trading. This lets you automatically execute trades right in your brokerage account. You're basically setting your trading plan ahead of time, based on rules that you define.
So it's like having a trading robot that just follows your orders. I can see how that would be useful, especially when the market is moving really fast. Okay, so we have global auto trading for like direct automation within our brokerage accounts. Anything else? Are there other services or tools that could help with this automation strategy?
Oh, for sure. We actually offer a few services that could really complement a credit spread strategy, like our weekly trend service. This one uses the power of automation to generate some pretty impressive returns through credit spreads on the S&P 500. And you can actually see its a 12-year track record if you go to our website. That's advancedautotrades.com/weekly trend.
12 years. Wow. That's a solid track record. It definitely shows what automation can do. But what about when the market isn't doing so hot? Does this strategy only work when the market's going up?
It's a good point. While bullish credit spreads work best in a rising market, we also have services that can be valuable in all sorts of market environments. Our weekly premium service, for instance, is all about generating that consistent income from weekly options premiums. So it can be a really good way to diversify and, navigate those different market phases.
So it adds another layer of protection, so to speak. Helps to smooth things out when the market gets a bit bumpy. What about, for people who want a real all-weather approach?
We've got that covered too. Our monthly trend service aims to capture those gains, but it's a much more balanced solution overall. Imagine combining these services, weekly trend, weekly premium, and monthly trend. You'd have this really diversified portfolio that can, basically handle anything the market throws at it.
No, that's what I'm talking about. It's like having all the right tools to weather any storm, right?
Exactly. And the best part is all of these tools are accessible and, can be tailored to your specific needs and risk tolerance.
I love it. Okay, so I think we've covered a lot of ground here. We started with the basics of credit spreads, then we talked about automation, and now all these different ways to diversify.
Right. We've really explored how to potentially tap into those profits from the S&P 500's tendency to rise using those credit spreads. And then we talked about making it all even smoother with automation and, of course, diversifying to manage that risk and, hopefully maximize those gains.
It's been awesome. But before we wrap up here...
Wait, did you just say wrap up? I thought we weren't supposed to use that phrase.
You're right. Force of habit, I guess. What I meant to say was, before we move on, I want to leave you with something to think about.
Sounds good to me.
This goes beyond just the technical stuff.
Yeah.
What's the biggest mistake you see new traders making when they're first starting out with credit spreads?
I'd say one of the biggest traps new traders fall into is, they don't quite get risk management. It's easy to get excited about those potential rewards, especially when you see how that time decay can work in your favor. But you got to remember, every trade has risks. Credit spreads included.
So any practical tips for managing risk when you're trading credit spreads? What should people really keep in mind?
Definitely. Position sizing is huge. You never want to risk too much of your account on a single trade. That way, even if things go south, you're not wiping out a big chunk of your capital.
Right. It's all about protecting yourself, even when you're feeling good about a trade. So it's finding that balance, that sweet spot between risk and reward that feels right for you, right?
Exactly. And one last thought. Never stop learning and keep refining your approach to trading.
I love that. Never stop learning. That's crucial for success, especially in trading, I think.
For sure.
Well, this has been an awesome conversation. Thanks for sharing all your expertise with us and our listeners.
Happy to do it. I always enjoy getting to talk about this stuff.
And to our listeners, we encourage you to really dive into the world of credit spreads. Check out the resources we have on our website, advancedautotrades.com. Try out those different strategies. And most importantly, keep learning. Keep evolving as traders.
Absolutely. And until next time, happy trading, everybody.
That's a wrap for this episode. See you all next time. If you enjoyed this episode and want to stay ahead with fresh insights every other day, don't forget to hit that subscribe button or follow our podcast. We've got more exciting content coming your way, and we can't wait to have you back. See you soon.